Haha, so after all this time, thank you, Vesna. Sir, muted right there, huh? So after all these times, and hi, welcome. Let me go back then. Thank you very much, Vesna, for that. Thank you for letting me know. Okay, so the topic for today is about how to protect your portfolio. And I showed earlier the chart of the S&P 500 that it basically dropped close to 10%, and actually, in fact, just over 10% for the past whole week. Everything's been very volatile, and for those who've been trading for quite a long time, I know a couple of you here actually that I've met since 2008, very similar to 2008, and things like that is simply opportunities will always occur, and when opportunity arises, this is where you need to basically part of that opportunity. Either you make a lot of money at the same time, though, like 2008, a lot of people also lost a lot of money, and hence by doing this workshop. You're the lucky few that would be able to determine that, hey, where to from here, just in case, it might be another opportunity. In my opinion, there is going to be another opportunity, both for buying and selling. Now, with the current marketplace, where it's currently now very volatile, I would recommend to be adaptable and change hats from investing to now trading. When there's a lot of volatility, this is where either you make a lot of money actually, and at the same time, and also the opposite side of the coin, right? You can also lose a lot of money. So as a form of risk disclosure, I'm not here to give you any form of advice. I'm just here to give you some piece of information in regards to what I see fit and what the market basically tells us. I'll give you some facts, some evidence on why the market could potentially drop even further, despite being an uptrend, still very bullish. On the other hand, what happened last week are just basically signs of the market is telling you, like, hey, you got to be aware, just be careful. There's a lot of hype, definitely with cryptocurrencies, and a lot of questions are, people always ask me, what do you think of Bitcoin? What do you think of cryptocurrencies? In my opinion, stay away from it. When something is not regulated and everything is all about being hype, just really think about it. When something is brand new and they wanted to market it, so what do? They need to market it, and through word of mouth, marketing. And hence, a lot of people who actually bought at 18,000 currently either lost a lot of money or no longer in the game. So my job is to give you some form of information in order for you to be part of the game, and at the same time for you to actually last a little bit more longer. If you have mutual funds, my opinion, I mean, that's not really the best way in terms of investing. However, if you have that, and at least you will know exactly what to do. If you're in the real estate market, I believe things are sort of slowing down a little bit in certain parts of the state or the U.S. itself. California, on the other hand, is totally different, especially in the Bay Area. If you are into trading stocks, options, futures, or even currencies, and I will show you as well in terms of what you could be able to do if you have current trades at this point in time. Part of the agenda is simply telling you more about the truths about trading and investing, of course, how to protect your portfolio, how to determine if you're really using the right trading vehicle for you, and then the analysis of the marketplace. And if you have any questions, please feel free to either write in your chat box, and then at the very end anyway, we're going to have Q&A. Alrighty, just a little bit about myself for those who don't know me. For those who know me, then just bear with me for a minute or two. I've been training now for 20 years, started in 1996, but full-time since 2002. Moved to the US in 2007 and met great, really good traders along the way, and also professional traders who used to trade on the trading floor. And I still basically maintain, I have actually good connection to Chicago, and every year I take private clients to the trading floor just to have a bit of an insider information, what's really happening behind the scenes when it comes to trading. Between supply and demand, because when you're looking at the chart, it's not enough. At the same time, remember, institutions will have all the pieces of information that we don't. I've been teaching for 15 years, since 2003. Also worked with one company in the past, but I moved out from there and simply just focused on my own because of certain things that I've seen in the process. Also, so I basically manage money. I'm a money manager. And in 2012, I wrote a book, Why You Could Be Destined to Fail in Trading, How You Could Avoid It, through a private publisher. At this point in time, I'm getting very good reviews with the book. I'm also in the process of writing another book, that maintains a little bit more in terms of the technical analysis component in conjunction with the mental aspect of it. So my purpose really in terms of teaching and why I love it is because in the process, like for me being martial arts, if you're teaching, then you become better in actual fact. Likewise, within our program, when students actually start to teach, the results go to a different level. And hence my purpose as a full-time trader and full-time teacher is simply just to inspire others, to help others be aware of the pitfalls of trading, that trading is for everybody, but not really for everybody, if that makes sense. At the same time, if people really want to be part of this game, is that there is certain process in order to be successful at it. Trading, I believe, is one of the best businesses ever that I've encountered. Of course, at the very beginning, there's always the ups and downs, but through persistency and consistency been made, and then mastery has been made. And in actual fact, you can make money in terms of there's no limitation. The limits is actually within you in terms of whatever belief system that you may have. Alrighty, let's go through about the truth about investing and trading. 75 to 95% of retail traders and investors lose money in the marketplace. That is a fact. In actual fact, I was listening to another friend of mine who is a professional trader and stated that about 95% of his clientele also lose money. I know another person who used to be a broker, and mind you, they don't make any money, and that 95 to 98% of retail traders lose money, and within the span of 6 months to 9 months, they basically lose everything. In most cases, some of them actually won't even go back into trading anymore. Be aware of the hype in terms of the marketplace, because there's a certain, what would the word be I'm looking for? Intention why they have to do that in order to market a certain asset class. Like I said, cryptocurrency is currently the trend, and everything wants to be into cryptocurrency. That were used, stay away from it. Also, the lack of education that creates the lack of knowledge and lack of skill. And one of the major components actually of the lack of planning and preparation. In most cases, people only want to make money very quickly. Trading and investing, in my opinion, is not a get-rich-quick scheme. There is actually a really good book that I would recommend for you to actually read called Principles by Ray Dalio. Ray Dalio was the founder of Bridgewaterhouse, and he currently, actually his company is now currently retired as of last year, and he managed about $160 billion worth in terms of the marketplace. He's a fund manager, and he's never lost for the past 40 years. And he wrote a book called Principles. I'm currently still in the process of reading it, but I would recommend for you to buy it. It's actually on Amazon. It's about $20 to $30, depending on which one. But it's a really good book. Ray Dalio is one of the people that I look up to. And he really never really exposed his secrets to the marketplace and why he's so successful, basically, when it comes to managing money. And now that he's now no longer trading or manages money, he wrote a book based on his own principles. Very interesting. It's really got nothing, at the end of the day, it's got nothing about your trading methodology. It's about your principles in regards of whether you can follow your own principles when you create your own set of rules. Alrighty, moving forward. Do you have any questions? Everything's so good? Okay, great. To protect your own portfolio, so here are the basically tips. One is I would recommend for you to get educated, regardless, whatever it is, whether reading books, stay away from seminars. Sometimes books, though, are a little bit, biased to a certain point, to a certain degree, because when the market is bullish, everybody will basically make money. But the question is what happens when a fear will put into place, like what happened where the Dow dropped 1,200 points, where the S&P dropped 5% out of nowhere. Where now we're also going to discuss where Yellen is also leaving the Federal Reserve, but it is, and I will show you that 70 to 80% that in March that they increase the interest rates. What happens when they increase interest rates? It is important for you to learn how to be an observer of the markets. Always read in terms of the market. The question is which ones to look for. You need to learn about the macro global economy in terms of its relationships. I believe they are very important. A lot of retail traders just go through technical analysis, go through a system. That is my old way of trading. In my opinion, it's not enough just to look at a chart. You need to back up your analysis and find facts on why you're entering in terms of a trade or why you're investing into something. Like buying a property, right? You're not just going to buy a property out of nowhere if you don't do your homework. The location of the property, whether the property has a lot of improvements that needs to be done, what if it has termites. So if you don't do your homework, then all of a sudden you have all this and you're locked in, then you're screwed, basically. Trading is no different. If you're about to buy a business, the same thing, you need to do your homework. So in my opinion, each and every time that you trade or you invest into something, do your homework. It is also imperative for you to learn how to forecast future price movement, which we're going to talk in terms of all this, by the way. You need to learn to be a risk manager, a money manager, and you need to strategize your money management and risk management. And lastly is simply, once you know the connectivity of the marketplace, is by learning how to hedge your positions. A good trader, a good investor is adaptable to the marketplace. That when something happens and if say you have a long-term investment, then how can you minimize that risk? So there are other avenues whether you'll be able to do that. Second point is to create strict guidelines and rules when you're investing and when you're trading. And lastly is to have good principles to follow your own set of rules. I believe that all of these, they go hand in hand in order for you to really protect your own investment, your own trades, your own portfolio. Okay, so let's go through about being an observer. When you're an observer, you are not being part of the marketplace, meaning that you're not a retail trader. You're not a retail investor. You cannot be part of the game because when you're part of the game, I guarantee you the odds and probability that you're going to lose consistently is highly probable. When you're an observer, you are doing your research. You're finding factual evidence on why you have to enter the trade. When you're an observer, you are being 100% objective. We're going to discuss that as well in regards to objectivity versus subjectivity. You will not be with the markets, but you are going, when I say you will be with the markets, meaning that you're trading with institutions, you're investing with institutions, you know the money flow, where they're holding. And I will show you some evidence and facts on why institutions were actually shorting for the past 3 months. And then now, because of the volatility, things have changed. It's so interesting. And now that actually they started buying as of last week. So when there's a buyer, there's a seller. When there's a seller, there's a buyer, right? It doesn't go the opposite. Now, if everybody's buying, then who's going to be selling? Nobody will make money. In my opinion, the marketplace is not regulated. Like in terms of education, is not regulated. Anyone can open up an account. Anyone can basically trade. Anyone can invest. And hence, it's really up to you to get your act together in order for you to get educated and get certain knowledge. I don't teach as well in terms of my secrets to everybody. And the reason is because if everybody knows now in terms of the secret base of trading, then everybody will make money. Yes, in terms of abundance, I believe there's plenty. However, there's only going to be a select few that are really willing in order to get into the marketplace to learn. So these are the people that I love to teach. Why? Because they will give their commitment, their time, and mainly the desire and passion to keep going. When you're an observer, you will have a low risk with a high probability of winning, and that would also lead to automatically that when you will win more consistently and make more money consistently as well. All right, so that's being an observer. So how is the markets basically connected? Well, everything is news-based. What happened last week, there has to be some form of news in order to basically shake the marketplace. And one of them, in terms of the news, is actually very interesting and saying that the computer generated all the selling and it created a lot of fear, and hence people start selling. Remember, based on supply and demand, that when there's a lot of fear, just really think about it. When you're fearful, right, at this point in time, a lot of people are actually also still being fearful. But you know what? We, on the other hand, we love fear. That's why traders love volatility. When there's a lot of fear in the marketplace, people get excited. On the other hand, the opposite side is that when there's a lot of hype and everything is going to the upside with no proof, this is where we, as professional traders, institutional traders, are being fearful. Why? Because you're waiting for it to pop. The question is just a matter of time. Now, as a retail trader and investor as well, and being a professional observer, is simply when something is too high, too expensive, I stay away. Just basically it's about timing. Or you want to get into part of the game, then you start doing test trades, putting just a little bit, pulling a little bit. And then where there's going to be some form of confirmation, then this is where you start to attack and you maximize your positions. It's like playing poker, right? If you know that you only have a pair, then all of a sudden the dealer is giving you more cards, and then the odds and then with you, and then all of a sudden you have a flush. Then next thing you know, you have a royal flush. When you have royal flush in your hand before even you lay it down, then you go all in. The same thing basically with trading. That's how it's supposed to be, right? News will affect the indices. Mind you, stocks are already part of the index anyway, with the S&P 500, with the Dow 30, and NASDAQ. So it's why in terms of trading stocks, and hence I don't trade stocks anymore, is because of that aspect, because it's the bottom end, and I don't want to be a bottom feeder. What I want is simply to go to the top, where to be as simple as much as possible and to eliminate complexity and add more subjectivity when it comes to trading. It will affect the index, it will affect the dollar index, it will affect commodities like gold, oil, copper, it will affect bonds, it will affect everything. On the other hand, to really understand the macro global economy in terms of the fundamentals is fully understanding the whole connectivity of everything. The dollar index, in my opinion, giving you a good tip right here, in actual fact is part of the secret in terms of consistency, is simply that if you know what the dollar index will do when news hits, and the dollar index will do, it will affect the S&P, will affect the Dow, will affect NASDAQ, will affect all indices. And from there, of course, there's a inverse relationship with the volatility index of the S&P 500. Hence, that's where when the market basically drops so much, the VIX, let me show it to you. The VIX basically spiked all the way to 50, right? 50 points. And if I just go through on the weekly chart right here, notice that the last time it did that was July 2015, August 2015. And since 2015, actually, for the past whole 2 years, 16 and 17, when there's not enough volatility, stated basically in our classes and the live trading classes that they have to retest this section. Everything that you see fit here, if you're good in or you're familiar with technical analysis, is that anything that has a higher upper shadow or lower shadow, in this particular case, this is like a gap. They need to fill that gap. So for the past basically 6 months, especially last December to January, when it created what we call a higher low, meaning that no one's willing to go and surpass a certain price point, basically part of my private clients and basically said, well, even if you buy a 6 month out, even a 9 month out call option with the VIX, or a put option with the Dow or the S&P, doesn't matter which one, the premium actually for the VIX during that time was so cheap, it was less than like $1 or something. And then it went to 100%, and some of my clients actually were very happy you pressed the trigger. And it's simply just a matter of time. Timing is basically a factor when it comes to investing and trading, and knowing when to enter and when to exit. And one of them actually told me, I said, what shall I do now? I said, well, you know exactly what to do. That if you're playing greedy, then of course, you will have some form of regret. But once you're now mega up, then you might as well cash in, because you don't know what's going to happen basically tomorrow. In my opinion, this is just the beginning. I believe there's more for it to happen. So when this happens, then automatically that the S&P 500 will also, this is just a start. Okay, but we're going to go through this more in detail a little bit later. And simply that minor correction currently occurred at this point in time. Yes, it's currently very bullish. Is there an opportunity to buy? Absolutely. And then when the time comes, this is where now we're going to go full out. When you have a royal flush, this is where we're going to full out and actually sell and short the marketplace. Okay, so for those, I mean, guarantee you a lot of people are still currently selling at this point or fearful. But on the other hand, institutions actually started buying. All right, moving forward from there. When the dollar index actually also goes up or goes down, it will affect oil price. It will affect the Canadian dollar. It will affect gold price. It will affect the Canadian dollar and the Australian dollar. It will affect copper. It will affect platinum, uranium, pretty much every resource that you could basically think of. And then the major ones, the Australian dollar, it will affect bonds, which will affect the 30-year yield. And it will affect the major currencies against the US dollar. Okay, so in terms of its relationships, when the dollar goes up, the S&P basically will drop. In a perfect world, by the way, when we're saying the perfect world is when there is something out of whack and there's some form of divergence, guess what? When you're seeing this, then you are going to be ahead out of everybody. So these are the things that we're looking for as part of leading indicators. We don't use lagging indicators. Yes, as part of the methodologies that we use, we have certain indicators, but they have a certain purpose of why we use them. Right? But nevertheless, in terms of leading indicators, these are the things that we look for. So in the perfect world, when everything is in relationship, when the dollar goes up, the S&P drops, the Dow drops, NASDAQ will drop, major currencies will drop, oil will drop, gold will drop, copper will drop, and the yield will go up. When the dollar index drops, then the S&P goes up, the Dow goes up, NASDAQ will go up, major currencies will go up, oil will go up, gold will go up, copper will go up, and the yield, or the 30-year yield, will go down. Okay, so these are basically part of our cheat notes that we basically look for. And then when that occurs and there's some form of divergence, then it's just basically really up to us to really identify which one's lagging, which one's leading. And then we will trade the lagging one ahead of everybody. And then by going through as well in terms of other factors that we look for, and then if we see fit that institutions are getting into that, then we'll go into it as well, nice and slow. Alrighty. Secondly, it is important to be a technical analyst. So a lot of retail traders actually do not know the meaning of technical analysis. They do for some reason, but at the same time, though, if they really do know, then the question is, why are they very subjective? Well, the definition of technical analysis is this: is the study of price movement or price action to forecast future price movement or price action using past and present price movement or price action. The key word here is forecasting. When we're forecasting, we eliminate subjectivity. We don't go through things like in terms of what I think, it looks like it's going to go up or it is. We eliminate that. When you're forecasting, you use historical data to determine the probability of direction of future trends. So when you are using historical data, then you're being objective. My background is actually physics and mathematics with computer science and math, and hence in terms of forecasting and statistics, it's pretty important. Yes, I didn't really use much of the rest, but with that background is simply utilizing what I know basically from what I learned at university and giving that more in terms of determination and measurement of the probability of winning. In my opinion, that is very important. Yes, measuring one's probability is very subjective. However, the only way that we can make it objective is that when I have a group of my students that we go through in our live classes, is simply creating a measurement, right? So think about like marketing, market research. If you did business and you did market research, say for example, Coca-Cola or Pepsi, which one's better? The only way for you to do that is say getting a sample of 100 people to drink Coke, and they will rate the taste out of 10. Some will rate as 10, some will rate at 7, some will rate at 8, and then out of 100, then you take the average in terms of the data. And then likewise for Pepsi, and then you can create basically the comparison from there. Same thing when it comes to trading. Yes, when you're doing your own, it is very subjective when you're measuring your own probability. However, in my opinion, I believe it's common sense anyway that once you have all the data that's basically in front of you and you have the intuitive process, you will be able to give a sound measurement of the probability of why you're entering. Does it make sense? Okay, so any questions? Stop me, by the way, if I'm going too fast or if you have some form of query, or you want me to explain something. Okay. So other than that, I'll move forward. Okay, the difference between objectivity versus subjectivity. The reason I'm stating all this before we go through to forecast the marketplace and look into it is because I want you just to fully understand where I'm coming from, not just as a presenter, but also as a trader. Objectivity means to me that it is a statement that is completely unbiased. It is not touched by the speaker's previous experiences, perception, and opinions. It is verifiable by looking at facts or performing mathematical calculations. Subjective simply has been colored by the character of the trader. It is often has a bias in reality and reflects the perspective through the trader's point of view, opinion, or perception. It cannot be verified using concrete facts or figures. Statements such as, I think the market will go up, it looks like Google will drop, and so forth. If you do your homework, and I invite you to do that, go through meetup groups, go through meetings, and I just want you to just sit down and observe. I guarantee you that if you go through trading workshops, notice in terms whether if they're being objective or being subjective. You'll see fit that the majority will be very subjective. And even with the system that basically they're using, I'll give you a perfect example. If I will tell you, what are you going to do when this happens? Are you going to buy, are you going to sell, are you going to hold? I bet you in this room, we were going to have different answers. Some of you will say you're going to buy, some of you are going to say you're going to sell, some of you are going to say I'm not going to do anything. That's pure subjectivity. On the other hand, if I'm going to give you facts and evidence on why you should buy, sell, or hold, then everybody will have the same answer. That's pure objectivity. Why? Because now we're looking at what the market is actually telling us. We're not using based on what we think. We're using based on what pieces of information that we can gather from the marketplace that will give us a sound decision-making process to choose whether to buy, sell, or hold. Okay, that's pure objectivity. All right, moving forward. Your mission, on the other hand, is to be a professional observer. As a professional observer, your job is to observe price action, get concrete facts to measure your probability of winning, and to eliminate ego, negative emotion, perception when analyzing charts. Ego, too, by the way, is when you think that you're being right, hence happens all the time. Instead, all of a sudden becomes hope. When you're hoping that it's going to go up and it's going the other way, it's because of the ego, because people don't want to lose. Nobody likes to lose. However, if you eliminate ego from out of the equation and you just accept it that, hey, you made a mistake, hey, it's going the other way because the market is telling you that to go the other way, then accept it, close your position, take that small loss or that loss in general, and go the other way. That's being objective. And by being a professional observer is you're going to be 100% objective at all times. Remember that the market doesn't care about what we think, you and I. It is not important. It is important to care what it thinks and what it is doing. The market only cares about what it cares within the marketplace, nothing else. So we, as little fishes in the open sea, the market doesn't really care. They call it the bottom feeders. Institutions or the big whales in the open sea, they're the only ones that take care, right? And hence, if you really want to make money, is to be with that whale. Stay away from the norm. And hence, that if it goes down, it goes down, it goes up, it goes up, it goes sideways, it goes sideways. Okay, so what is the common chart that a technical analyst normally use? Well, simply candlesticks. And let me go through here in terms of definitions of why candlesticks. This is actually being taken by in a book with Steve Nissen. I only actually share a piece of information written by Steve Nissen, who brought candlesticks to the Western world. But if you read through here, candlesticks are normally used because it pictorially displays the supply-demand situation by showing who's winning the battle between the bulls and the bears. Like the bar chart, the candle chart shows the trend of the market, but candles add another dimension of analysis by also revealing the force or lack of force behind the move. Notice on this side, the key word here is force and lack of force. Looking at the two-dimensional chart is actually very challenging, but this vibrates, goes up and down every millisecond, especially now that everything's through high-frequency trading, everything's all computerized. That has a lot of vibration, and this is a weekly time frame. And notice that if I change the time frame to 1 day, that 1 month or 3 weeks is based on 10 days right there. And if I change that to as low as 1 hour, you will see in terms of the vibration that has created to the downside, and imagine the amount of force and the volatility base when you hit from 2760 all the way down to 2540. Okay, so you'll see the amount of momentum or amount of force that's been generated. In actual fact, we can determine the amount of force that every candle that base has been performed based on Newton. You can calculate that mathematically. And when you can calculate things mathematically, you'll be able to create a better sound decision on what you can do trading in the marketplace. Okay, so force and lack of force, and hence that's why I use candlesticks, because it can actually tell you specifically. But there are things behind the scenes that goes through there, and hence we don't use price patterns. We are just purely just through price action. I believe there's a science behind trading, and once you can see in terms of and fully understand what's happening behind the scenes, it will add in terms of your probability of winning. All right. Number 3, it can give you certain reversal signals, but I don't really use these aspects because sometimes it can give false hope and what we call false breakouts, false reversals. And so we mainly focus more on the price action itself based on if it's opening price, the high price, the low price, and the close price, which is also very similar with Western technical charting. It is also very important to protect your own portfolio. It's important to be an excellent risk and money manager. It is important to know your risk of ruin. Your risk of ruin is simply a statistical concept that tells traders the probability of them being ruined, also known as a point of ruin, and then knowing your positive expectancy, where it is the average amount you can expect to win or lose per dollar at risk. There's a mathematical formula for that, and take notes. So simply it is the expectancy where the probability of, and hence in actual fact, it is really important to know your probability of winning, your win-to-lose ratio, and also the probable winning of the methodology that you're using. The probability of win, and you multiply that by the average win, and then you subtract that by your probability of loss, multiply that your average loss. And you can determine your expectancy, whether you'll be making money within that whole week, that whole month, based for the whole year. If you can be able to do that, then awesome. You can make, it doesn't matter if you have a win-to-lose ratio of 50%, but your wins are bigger than your losses, then you'll definitely make money. But imagine though, if you have a methodology that can give you 80% success rate, and you can be able to manage your risk of ruin, you can manage your positive expectancy, then you'll make money on a monthly basis for sure, definitely. On average, we make about 10% on a monthly basis. Okay, that's basically consistently. Do we win all the time? Absolutely not. We have an 80% success rate. However, managing that 20% success, 20% loss is very imperative. I had one big loss actually, November. So prior to Christmas, and it wiped out all my wins for the whole month. And the reason being is because one, the market's just being the market, and on the other hand, my mistake was by adding more in terms of the position. So, but rather than making more of a bigger loss, is by offsetting and closing the position and to make it basically breaking even. So, but nevertheless, December was a profitable month, January, and then now we're in February. February is basically a good month for us at this point in time because of what happened basically a few days ago, or basically last week. Also, very important to always put a calculated stop loss. Know where to put your stop loss and target points. Every professional trader that I know of, and from people that are mentors that I learned from, is simply to have a calculated stop. We calculate our stop losses first before our target points in terms of our profits. In my opinion, it's very important. And the reason being is that if you have a calculated stop, it will eliminate any form of fear. And plus, if you accept that the loss even before you execute the trade, then you're not going to have any form of fear. Does this make sense? Lastly, to protect your portfolio is to hedge your positions. Hedging is simply a position established in one market in an attempt to offset exposure to price changes or fluctuations in some opposite position with the goal of minimizing one's exposure to unwanted risk. Hedging is considered an advantage strategy that can help protect your portfolio. Hedging reduces your risk in times of volatility. Hence, basically what happened last week. And so by telling my private clients and also the money that I do manage for private clients is by offsetting it off, and we shorted basically the futures market, shorted the S&P, and shorted the Dow. And also as part of that diversification of the portfolio is we also basically bought a put option in terms of the S&P and the Dow. And in actual fact, we also bought the VIX. So imagine everything is basically all covered. So even though some of, my clients' stocks basically dropped, they're still actually being ahead at this point in time, especially for the longer term stocks. And some of them actually are already basically recommended by looking at analyzing some of their stocks is to actually now buy some more. Okay, and now changing the strategy rather than now holding it is to hold it to just a certain amount and basically closing it to a certain time when the time comes. So these are the things that we do. These are the things that you as an investor, as a trader, should basically do, in my opinion anyway. Once you are a trained technical analyst and you can understand fully of the whole macro fundamental, you might be thinking, it must be a lot of hard work. Yes, I got here and didn't happen overnight. I mean, I'm doing this now for 20 years, and I lost a lot of money in the past as well. But it's mainly through the persistence, in my opinion, whatever business anyway you get into, that if you just stick into one business and you keep working at it, I always tell my students that it's about, for them, is not about learning how to, thinking of making money at the very beginning. Their job is to focus the process on how to make money trading the marketplace or investing in the marketplace. And the reason being is that if they're thinking about making money automatically, then they're going to be part of their expectation. They're going to be disappointed that they're not making any money. So by telling them ahead of time that, hey, it is normal that you're going to fail. In my opinion, failure is part of success. Because if you're already successful at the very beginning, you're not going to make any mistakes, then what's the whole point of learning? They're not paying me all this money in order to be perfect. They're paying me money in order for them to learn, in order for them to teach them that failure is part of success. So by doing so, if you have all of these and you can practice, you fail, and knowing exactly what to look for in order to progress as part of the progression, and you will know which mistakes, what to look for, and how you would be able to manage that mentally, technically, and physically, then this is how you get to the next level in terms of trading. Like I said, trading, I believe, is for everybody, but not for everybody. And at the same time, trading is one of the best businesses ever because you can trade anywhere, low overheads. All you need is your knowledge, your skill, internet, laptop, capital, and that's it, right? There's no limitations. You want to make 500 bucks? Then it's both, so be it. You want to make 500 bucks? I mean, $5,000, so be it. You make 50,000, you make $500,000, so be it. There's no ceiling in terms of cap. Of course, the ceiling will happen based on the capital that you may have. Alrighty, moving forward from there. Okay, let's go through in terms of the markets and see what's happening. Okay. I will go through first in a bigger time frame. The reason why I go through on a bigger time frame is to look at the overall picture. You can see that whether we like it or not, the market is currently still in a bull market. There's nothing dictating that this is going to fail. Okay, so I'm just going to make things very subjective because time is a factor. And it's 6:43, and depending on where you live in the East Coast, it's already 9:43. You live in Chicago, that's 10:43. I'm sorry, 9:43. And bear with me for a second. Of course, you live in the Pacific Standard Time. In California, 6:43. It's also dinner time. Okay. I'm going to be clean as much as I can. Okay, let me pause the video for a sec. So you can see here. So there's really nothing on that side. I'm just trying to see nothing. So there is this big empty space right here. Let me maximize this. Right. In technical analysis, there's two components. You have price, and then you have time. There's one element that we use that a lot of traders actually don't know is simply this segment called D, which is distance. Every single price point that we look at, say low price, like everything here, there's low price right there. And when something like this happens, when a low price is lower compared to the previous low, and then all of a sudden there is a next low which is higher compared to the previous low, everything here means something. And these are the things that we look for. These are the type of piece of information that we look for. Every number that you see fit that appears over here is we put it in consideration. That's pure objectivity. And the reason being is because they do mean something. It also depends on the meaning you put into it. However, if you have real numbers on the line and lows are institutional price points and no one's willing to go below that low, that means then this. Trading is like an auction house. Or just imagine you're buying a property and you're putting a bid, let's say here at $1.9 million. Someone placed a bid, on the other hand, at $1.8 million. The seller is not willing to go below that. The seller says, no, go away. Now, perhaps I will only do that if there's no buying that's been pulled into place. However, if the seller is not willing to sell at a certain price, say here at 1 point, so this one to be exact, $1.807 million. And all of a sudden, price ended up at $1.9 million. That's 100,000 more than what's been basically expected. Will a seller really be willing to accept a buyer's bid at 1.85 or even $1.875 million? Absolutely not. Now, if sellers basically disappear and all of a sudden one buyer comes into play and basically says, "Hey, you know what? I'm gonna buy the whole complex, but I'm not gonna buy it like, at 2 million. If you give me a discount, I'll buy it from you for opening price of $1.93 million. Then I will buy the whole complex." Seller says agrees to it. Bam! Then all of a sudden, everybody in the neighborhood starts to buy, and all of a sudden, it ends up at $2.1 million. So that's how we can determine, but in terms of the low price points, that there has to be some form of a big institution in order to buy a certain price, and the seller is willing to accept that price. Does that make sense? Okay, that's why the lows and the highs are very important. Now, very similar, if price is too expensive and you don't have clear-cut evidence in terms of the past, and you can't compare it, there's no comparable, there's no comparison, very similar to a property, then how is the value really evaluated? Like here in California alone, in the Bay Area, price it just keeps going up because there's not enough supply and a lot of demand. That's why Google is expanding, Apple is expanding, Facebook is expanding, but there's not enough supply when it comes to accommodation, and hence is why they're buying developments left, right, and center. And in actual fact, there are a lot of properties are being developed in the Bay Area, especially here in the Silicon Valley area. I don't think that's not going to drop either. Now, I don't know what's going to happen when interest rates goes up. Of course, very normal. And you can see through here in terms of the chart, 30-year mortgage rate chart, which is, by the way, this is not very, very similar to what the FOMC in terms of interest rates. Here, by the way, it's already 71.9% that in March that it increased from 1.5 to 1.75 basis points. So in other words, they will increase the interest rates for sure. Now, if you're a property owner and your interest rates goes up, what happens to your mortgage? What will happen to the mortgage? Sorry, so apparently you can't see the screen. Let me thank you for letting me know. I will stop the screen share for a second and then redo it, okay? All right, so if interest rates goes up, what will happen to the mortgage? What will happen to your mortgage? It will definitely go up, right? Based on adjustable rate. And now if here it's going to 1.75, this will also go up depending. I actually have a friend who works with Federal Reserve. Actually, she does stress tests for banks. Okay, so when that happens too, guess what will happen with the dollar index? It was at 88, creating a higher low. Forecasted the dollar index will go to 990. I know it's still pretty down, but check it. If this one finishes like this, these are basically my notes. This is a good area of demand, meaning that a very solid demand area, because in 2014, 2015, they did break that. After 2008, tested it, retested, dropped. We tested that. First time it broke out was 2006. Failed all the way down, dropped all the way down to 70. And these were the financial meltdown. Went back up. Guess what? Retested, dropped. Came back up, retested, basically dropped again, retested, dropped. And then after from 2011, 2014, breaking out from this supply level, reached all the way to 104. From 104 from 2017, the whole year basically the dollar was dropping. And then one of the key people saying, hey, we're going to have a stronger US dollar. Trump also saying we want to have a stronger dollar. And if it finishes like this, odds and probability that the market will retest back to 94 and 95 is highly probable. And especially when March comes along, I have no doubt we will go through that. So with that being said, while I'm here, so you have for sure, that's for certain that it's going to go up, and hence we actually started buying the US dollar. We're playing the game at this point in time, medium, short term, we're playing the game. We went long the US dollar CAD, we went long the US dollar Swiss. Actually, in fact, we also shorted the euro. However, I believe there's some more in order that for to happen. Finishes like this, we're going to short basically the euro from here. Why? Because the euro plays a bigger role part of the dollar index compared to the rest of the major currencies. So that being said, and I'll go through in terms of the relationship right now. This goes up, S&P basically drops. Currently, they are in perfect relationship. Okay. Here is a commitment of traders. And this I'll show this way better. What happened to that SP futures price, commitment of traders. Waiting for it. I'll go through 5 years. Waiting for the data. While it's doing that, I'll go through here. So if you see fit here, since September, the green line, I don't know if you can see it on your screen. This one, it's called large speculators. These are your institutions. Small speculators are your retail traders. Commercial speculators are your hedge fund managers. That's why if you notice, the small speculators are your retail traders. So you notice they're buying. Your large speculators, your institutions, they've been selling since September. September, October, November, December. So 3 months. While the market is going up, they've been shorting the marketplace. Mind you, though, of course, they just don't keep on selling all at once. They do it slowly because they do it everything all at once, then something like this will happen. They will push the price and they'll be in trouble. So in order for things that they have to follow certain guidelines within trading, they have to short it very, very slowly. And then notice now though, see here, let me see. Okay, this is actually now where the king of the crop is important. And 1 year is actually good. It's taking its time for a sec. Now that everything is dropping, institutions now started buying. They actually already bought from here, actually. Why? Because, like I said, overall, the market's still basically in an uptrend. Therefore, there's an opportunity in terms of the marketplace to go back and to go long. However, there is a caveat. It's all about timing, knowing when to get in. On a weekly time frame, because of this, see, notice it broke through. We're going to have a lower low, lower low, lower low. If you don't know what lower low means, it is a terminology that we use in technical analysis that the low of the price is now lower compared to the previous low on a major price point. Someone was willing to sell below this low, No one was willing to buy. Someone was willing to sell below this low. Someone was willing to sell this low. So everything you see fit here is an important price point right here. That being said, when you have a lot of force, you cannot fight against this force at this point in time. In my opinion, in terms of short term, there is going to be more selling pressure to the downside. Perhaps they will retest around 2620, 2600 right here, even perhaps around this segment, 26 on this side. This is actually now where we use advanced techniques, intermediate for others. Okay. So from the top of the price to the bottom of the price, they have to correct itself, meaning that when something is way oversold and there's no demand, they need to create demand, meaning that they need to make the price so cheap for people to buy, and that when it becomes oversold once again, there's some form of selling pressure, then they have to drop the price. So here it retraces all the way to 50%, and the 50th percentile, the question now is, can it go back down to 0, which is now 25.29, or can they hold certain price around demand levels like 26.20? Once I see fit in terms of what we call a higher low, where no one's willing to surpass this low, then this is where we can go back in and buy back. Okay, so that's the key. Short term, it's going to be bearish, medium term to longer term bullish, because they need to retest this high once again. Perhaps, depending on when FOMC meeting minutes is going to be, that's March, next month, for the whole of March. ECB, so March will normally is a very volatile month. Wednesday, 2 o'clock, no, 16, 21st. March 21st, for sure that they will increase the rate. Then they need to, March 21 will be right here, somewhere there. So either the price will consolidate, will go further up this way on the S&P, and once it reaches to a certain point by the 21st, I wouldn't be surprised if this is going to drop. So in other words, this is what it's going to look like. In terms of volatility, and then it's going to fail somewhere here. Okay, because if they retest this price point even better, then how would that look in terms of the dollar index? Very similar. Based on a daily time frame, there is nothing supporting it that is going to go back up. And the reason being is because everything is still on the downtrend. So if I'm going to draw my trend lines, just to define where the trend is, and if we put in here, there's some room in order for that to get rid of. You have a lot of force over there. All right, approaching supply level. And then once there's a turn, they need to retest certain price points halfway, perhaps around here, and then retest somewhere on this side or this side. When there's a clear breakout on this side, price will go all the way back there, because by nature, if they will increase the interest rates, this will definitely head to the upside. That's one possibility. So we go through over even here. Second possibility is that they will already break the secondary downtrend line and then keep pushing. And this is what happened actually last time when they increased their interest rates. There's nothing because everything's already been factored in. So if they break through this border in terms of this borderline of a trend from a secondary to a primary, then they will fill in this gap. Okay, so these are the things that we're looking for is 1, 2. Therefore, there's an opportunity for shorting the US dollar. There's an opportunity for buying the euro right at this point in time. But once the time comes and it creates the higher low, and this is where we have a royal flush and we're going to go full force. Right at this point in time, we do not have a royal flush. This higher low is just a short-term correction because they need to correct itself from top to bottom, from the last impulse to the last low. So somewhere here. Okay, so once again, like I said, interest rates is definitely for sure they're going to increase. What will happen to that? This is going to go up. So when that happens, what will happen now with oil? Very similar. Notice that oil has already been dropping. But there is nothing dictating in terms of this is really going to fail. In my opinion, this is also going to rebound to the upside, back to around $70 a barrel. And it creates a lower high, then we're going to sell it. Can it come back down to 64? Absolutely. Did we already short oil? Yes, and hence that's why we went long the dollar CAD last week, made 200 pips. Beautiful trade. It's because of this aspect. Now we're out of the dollar CAD because of simply a part of the correction. So if you go through dollar CAD, remember CAD is in the same relationship with oil. Okay, so oil has been dropping, CAD dropped, the dollar basically went up. So it's currently in perfect unison right at this point. How about gold? Gold also dropped. The reason is because the dollar kept going up for the past 2 weeks. Oil also dropped. Nothing dictating to, however, I'm more bearish with gold because notice this high, they're not willing to go beyond this high. So everything you see fit here is in a level of supply. And part of that, in terms of supply level, price will come back down to around 1,260. And if it breaks through all of this, then easy, it can go all the way down to 1,100 an ounce once again. My own opinion, once interest rates will go up, everything will start to drop once again. Okay, so hence, check it. Also made good money with the Aussie because we started shorting the Australian dollar against the US dollar around the 81-cent mark. Right there. When this actually formed, and just simply just waiting, and 81, 80, 79, 70, 400 pips to the downside. Currently, we closed the majority of the positions. Actually, there's only about 10% left in terms of our positions. But because it's such a strong force here, can they break it to the downside? Perhaps. But if they don't want to do that by tomorrow, then we're going to close the rest, go back to the long side, and then short again. And when the time comes, Okay, so that's the relationship between gold and Australian dollar. And you know what? Copper is also the same. And notice copper basically dropped. Copper was in terms of divergence, copper was ahead out of the Australian dollar, and when that's why we followed suit. Okay, so I believe there's more room for this to drop back down to 3 before it can go further to the upside, right? Then you have the yield. So the yield is the interest of the bonds. One of the major reasons why we went long the dollar is because the yield is currently leading at this point. It kept going up. Also, this automatically means that they have to raise interest rates because of the yield, right? The treasury yield. So that automatically means then here, on the other hand, though, notice we have, we call it a shooting star, the same because a lot of momentum, a lot of force, some selling pressure, and then buying pressure getting there, approaching supply. Can it go further? It could, but if they don't want to play the game, then this is going to come back down. And that's actually based on the daily time frame where it's at. So it's still very bullish. Depending on what we'll do tomorrow. So since it's also bullish today, I believe the dollar index has also some room in order for it to head back a little bit further. Okay, so that's with the yield. And last but not the least, let's look at Bitcoin. Oh, before I go to Bitcoin, that's the macro global fundamental analysis. I want to see whether they are in unisons within each other. If they're not within unisons, then I need to look in terms of which one's lagging, which one's leading. Here, I did something. It was 7,000. It dropped to 6,000, and then it said there's more to come in the future. Yeah, it went up to 19,000, and then this basically occurred when this one happened. This is a very strong indicator that it will potentially drop. You know, how far, who knows? But in order for it to drop rapidly, Bitcoin has actually been very volatile. Look at that. In my opinion, there's definitely more room for this to head back. I won't be surprised. We'll come back down to around below 2,000 somewhere sometime in the long run to retest this area once again before it can continue to go to the upside based on a monthly time frame. Based on a weekly time frame, currently settling down, settled at 6,000. You have seen that lower high, part of lower low. And then next one, target point, if it chooses to come back up, see how steep that is? 11,000. Could potentially go back to 11,000 and play this game until we will reach somewhere back to 3,000. So I met a kid. She graduated from college, worked in the workforce just for a few months, and then quit his job, became a consultant, part-time. Actually, he made good money trading cryptocurrency because he got in at 2008. I got introduced. No, he got in at 2011. I got introduced in 2009, 2010, but I didn't get into anything because I just didn't know about it. And he told me that it's not that easy to get in, and the reason is you also need to know how to program, which I didn't realize that because everything is all digital. But nevertheless, he made a few $100,000 by trading Bitcoin because he got into the right time. I don't know now though, because this was about close to a month ago, and this was before the big drop and where it actually happened. So either he got out, I'm curious on what basically did, but nevertheless, he stated also the same, that a lot of people are getting into it without knowing really how it works. So now probably is a better time of buying, but I'm not advising you guys to buy, but that's just from what I see. You can go to 11,000, but just be careful if you get into this type of trading environment, right? So nevertheless, that's in terms of what I see fit in terms of the cryptocurrency with Bitcoin itself. Macro fundamentals, it's so easy at this point in time. Everything's all in sync. I believe there's some opportunities for selling in the long run. Likewise for buying as well, though, but not yet. Short term, I'm still bearish. Medium term, sort of bullish. And then March 21 happens. I believe this is the major drop that's going to occur where the dollar will go to the upside. I will definitely do another workshop in terms of maybe more of a market update. Summer sometimes get closer to what's happening in terms of the marketplace. Okay, so that's in terms of the analysis of the markets with the macro global aspect. Any questions with that? Hope you guys took some notes, okay? And in the end, if you have some stocks for me to look at, let me know, and I'm more than happy to look at it. So likewise, in terms of protecting your portfolio, is you need to create strict guidelines and rules. It is imperative to know why you are trading and why you're investing. Yes, the number one answer is to make money. Absolutely. Right? If I were you, just be smart about it. Spend money with your education, in my own opinion. It's important. Get some knowledge, and you have some knowledge, you increase your skill set, you will increase your confidence level for sure. Knowing on how much you're willing to risk in each and every time that you're trading or each and every time that you're investing. When you're trading stocks, you know exactly in terms of your risk anyway. So if you're buying a $50 stock, then you're risking $50. Worst case scenario, it goes down to zero. Okay, but at least you know exactly. But if you're going short, all of a sudden you have now unlimited risk because the price keeps going up, right? So that's one thing. Hence, that's why having a calculated stop that just in case it goes against you based on unlimited risk, then you will get, you only be losing the X amount of money that you're willing to risk. Now, if you're going to double down, make sure you're doubling down when you're up. Never double down when you're negative. This is how a lot of people actually lose money. These are gamblers. You do not want to be a gambler. You want to be a gambler, then gamble, go to Las Vegas or Nevada, even better, right? So at least in that way, you're having fun. Trading is not a hobby. Investing is not a hobby. It is a business, whether you like it or not. Likewise, are you being objective or are you being subjective? Being objective is when you have a lot of evidence in front of you, you enter the trade, rather than being subjective. And a lot of people, I know exactly when a good trader is. I know when a trader is novice. I know when traders will give me their spiel in terms of what they think of the market. At the end of the day, the market doesn't really care what you think, to be honest. If the person gives me enough evidence or facts on why I should buy or sell, then I know that trader is a professional. But if they're using systems and using indicators and price patterns, they're just all subjective. At the end, the market doesn't care what you think, and based on your own perception and what the price pattern does anyway. If you know the purpose of that price pattern, then that's a totally different ballgame. Being subjective when you're being righteous and you're thinking that you know that you can beat the market, that's pure ego. Ego will ruin your trading career. You will ruin your investing career. Stay away from it. And by being, meaning that if you are being of who you are being, then you're purely being objective. Lastly, also knowing on how long you're going to be in the trade or when you're investing. Investing is mainly for longer term. And if you're investing, then make sure that you're using different strategies to hedge your long-term investment. If you see fit that there's more to come in 2018, 2019, then so be it. Sometimes being cashed, though, is also really good because when you're cashed in, hey, you didn't lose anything. But if the market basically keeps tanking, you're safe, right? Rather be safe rather than being fearful that you can't sleep at night. Okay, so those are your guidelines. Those are rules. It's important to create your own set of rules. Lastly, is to have good principles to follow your own set of rules. Principles are simply a set of values that are important to you to succeed in trading or investing. such as integrity. You know, that you state to yourself that you're going to do it, then make sure to do it. Patience, being patient, because if you're being patient, then it avoids anxiousness. Okay, to be impatient. When you're impatient, and that's where people actually make a lot of mistakes, is because they are being impatient. Likewise, for taking money, is greed good? Absolutely. As long as the market can give you more, then hold it. If the market can give you any more, then that's now you're being greedy. When the greed comes into play, then that's now just pure ego. Once again, responsibility, discipline, balance, intuitiveness, meticulousness, being focused, being committed, motivated, optimistic, and determined. Okay, these are just certain values that you need in order to follow one's rules or guidelines. When you have all these principles or values, then, in my opinion, you will be able to make money consistently in the marketplace, whether you're investing or you're trading. Okay, so very important. Those are certain elements. These are the things that we focus on in terms of our trading program. It's not just about a trading system. It compromises the mental conditioning, mental aspect of it, the spirituality aspect of it. Because I believe trading is not just about making money, it's about everything, right? Because if you don't have that, money or the result of money is just simply a reflection of your own principles or values, meaning your own self. Okay, to summarize it, to protect your portfolio, it's imperative to increase your knowledge through education. Get educated, because when you're getting educated, then you will increase your knowledge. When you increase your knowledge, you increase your skill. When you increase your skill, you increase your confidence. When you increase your confidence, then you will be able to invest and trade more with less fear. Get coaching, definitely, because you can't see 180 degrees that's behind you. You only see 180 degrees that's in front of you. And then apply what you've learned and be a very good risk manager. Be very good in money managing. Okay, be a very good money manager. So these should be your affirmations, that you're a good risk manager, you're a good money manager. If you don't want that in last work, then find somebody who would be able to help you to manage your own stuff. Okay, so have strict guidelines, have good principles, values to follow your rules, that when opportunity arises, take that opportunity and never look back. Okay, and you take massive action by going through all your portfolio from top to bottom, see what strategy you can implement. If you don't know how, I'm more than happy to actually give you a 30-minute consultation and to go through from there. We offer self-learning programs where you can study on your own. It's a video-based program. So you're just seeing me talking. There's a lot of exercises, and then you're being backed by a support twice a week with live trading, group coaching, and so forth. These are for the people who actually work full-time, who doesn't have the time to come into the classes where we have class-based programs. Okay, so, and lastly, for those who just want to get full out, they want get knowledge, get private mentoring one-on-one, basically from me, but I only accept only a few people basically a year. But nevertheless, by having all those three, at least you can have something there solid for you. All you got to do is just take massive action. That's basically it. Okay, so that's the end of my presentation. I know there's a lot I wish I could go through a little bit more. I know time is a factor. Sometimes they're kind of late for you guys. You know, it's dinner time. If you have any questions, please feel free to email me at estraders@gmail.com or call me directly at 650-390-7104. And I'm more than happy, like I said, I'll get in touch with you and see if you, in terms of your consultation, if you have any stocks or something you need to look after and whatnot, then I'm there to help you out. Okay, thank you very much. Thanks, Brian. Thank you, Judy. Good to see you. Thanks, Joe, for coming in, and Charles, Deborah. Good to see you. Abtakur, Vesnar, Siva, LK. Right, so do you have any questions? I will unmute the mic. If you have a mic, then it's all yours. You want me to look at any stocks that you may have?
Thanks, Ray.
Thank you.
So, no, never mind. You already answered my question from before.
Oh, okay. No worries, Brian. Charles, you have any question?
The self-learning class, are like the prices and stuff on your website?
No. It's actually a new program that started as of this year because the whole month of December and November I basically recorded necessary modules because there's 16 different modules for the beginner program, intermediate, and advanced. So they go in different levels, but they are, yeah, I spent basically a lot of time recording them. And simply there are, where is it, what it looks like? Give you an example.
Hey Ray, Joe here.
Hey Joe, how you doing?
Doing well. My daughter Sadie says hi. She's watching along. Going to be a little trader.
Hey, lady, how you doing? I have to visit you guys sometime, huh?
Yeah, I know it's been a long time. Question for you: in your rooms, because I haven't been in your rooms in a while. What are you still majority forex, or you with the change in markets? Are you looking at more different instruments?
The majority of my trades are still currencies because it's the easiest, to be honest. And then, but however, if there's any opportunities, but because we look at the overall markets now, then I trade futures, mainly the ES or the YMs. I don't trade the NQs. Then I basically either go short or go long. Very seldom I do options. I do, if you guys want to learn options, I mean, I have really good guys from Chicago that can basically teach. One guy he can't because he's in a private firm. One of my students actually, as one of the trading firm, they make like ridiculous amount of money in terms of trading firm. One of my students actually, that I referred to the trading firm, he's number one and number two in terms of the whole firm. He's never lost actually a single week. Why? Because they have strict rules, and part of those rules, you need to follow those rules, and simply just the foundation itself that's been built becomes easier for actually the trading firm that I have a good close connection with. But nevertheless, to answer your question, majority of my trades are still currencies. The accounts that I do manage from basically private clients are still currency. But however, if we choose to hedge it, then we hedge it via using futures.
Thank you.
You're welcome. And so, Brian, to answer your question, that's what it looks like. So, depending on the module, some are 30 minutes, some are 20 minutes. But there's a lot of exercises that you have to go through before you go to each module. And then you email your homework, and then you go to the next module, and you have two times a week in terms of support between actually 8:30 to 9:30 Pacific Standard Time or 7:30 to 8:30.
Oh, I see. So, have you made prices for those classes yet?
Yeah, so it's $499 for the learning class for the program. $99 goes through for the whole month support because not just.
Wait, that's for the whole. That's for everything.
That's for the whole beginner program, correct?
Oh, okay, that's not bad. Yeah.
Yes, and this because it's all video based, and then of course I need to also look after one of my teachers, and the $99 goes to pay for the whole support class, basically.
Right.
But it's an ongoing support system. And then,
if I have questions in between the modules, could I email them to you?
Absolutely. That's part of that, and part of the support class is to ask any questions that you may have. We go through a lot of more exercises, a lot of, mainly infinite, if you have any questions, absolutely. Because you have to do the homework and you have to email the homework anyway.
Oh, I see.
Yeah.
So just two things. Want to recap what you were saying earlier. So you think it looks as if the dollar is going to continue its drop. Well, the trend is down until the rates go up, right?
In terms of the U.S. dollar itself?
Yeah. So the rates are going to go up once the I mean, once the rate goes up, then it's kind of going to go up again, right?
Yeah, this is gonna fly for sure. Like, I
Okay.
have no doubt it's gonna fly. Like, but you know, you have to be aware though that it could fly even before the interest rate will go up.
Oh, I see.
Yeah, but nevertheless, it is definitely certain that they will increase the interest rates and be locked on. So
And then,
that's a good website right there that you can use. It's free.
okay.
Something in terms of a trading tip that you can maybe utilize by looking into what institutions are.
I didn't say anything, honey.
And then the other thing is when you were going over the S&P 500, so you're thinking it's going to go lower when the rates go up, right? Is that what you think?
Absolutely. That's my opinion.
Right.
Now, prior to the March, I believe that, I mean, like I said, they will, now that it's stabilized itself, there's opportunities of actually buying in terms of certain stocks. Like if you're dealing with the S&P 500 or anything you go through in terms of large caps anyway, it will, if it'll drop, it will drop. It goes up, it goes up. You know what I mean?
Right.
So even like, I mean, real estate, for example, ETF, let me go through that later. But nevertheless, yes, it has to stabilize. It has to come back down to retest this area.
The red area?
And, yes, this area right here. So good solid is here at 2620. 2620 and 2600, right? These are good solid price points right here. Why? Because here, they're supporting the price.
So I should probably sell my put option there then, right?
Yeah, you should have sold your put when this actually
happened. Yeah. But then if I had to redo it, I guess that would be my best exit.
Yeah, if it comes back around 2620, but mind you though, your premium will decrease in value each and every time a day goes past, if you know what I mean.
Right.
So,
but I bought it right at that peak because somebody told me to do it.
So if I were you, I mean, take some of the profits and, get cash in, because you don't know
what it's going to do.
Exactly. If it goes up and your premium once again will decrease significantly, right? So.
Right. But my contract term is 2 years, so.
Oh, okay. Gotcha.
Yeah, so there's still plenty of time.
Yeah, you'll know what to do. But nevertheless, once price gets around this level, and then if it comes back up, what we're looking for, since only a few of you guys, here's what we're looking for. And please don't share it to anybody. Okay. Once it reaches here, you see a lower high.
Lower high.
It could be here or it could be here. This is definitely where
resistance.
A big sell.
Oh.
So once it's stabilized on the supply where no one's willing to go beyond here, then this is where you sell. Because nothing dictating that it's going to tank, right? Because everything is pointing to the upside. If you're buying, you will win. It's a big G word, but guaranteed you will win. If you're buying here, you will win because everything is pointing to the upside. You're having the best price point with the lowest risk with the highest probability.
Oh, gotcha.
Okay, but if you're selling here, you will lose because the trend is up. You're against a big current that's flowing to the upside.
Right.
However, here, once you have no indication, or the indication beyond that is the starting point. So
I see.
Sail all the way down.
Any specific reason why that lower high is where it is in your?
Yeah, that will take a whole class, my friend.
Okay.
Yeah. And that piece of information is a lot of money.
Well, yeah, I like the idea of your online classes. I think that's how I learn best anyway. I can rewatch the videos.
Yeah. Sounds good. Okay, so that's basically that's what I could give you in terms of piece of information is that you wait for it, but I am a buyer when the time comes because I believe there's some good opportunities for buying. And then when the time comes to sell, then the second wave will start to happen.
Okay.
Okay.
Thanks.
You're welcome.
Oh, by the way, what tool is this that you're using?
TradingView. TradingView is free. So.
Oh, okay.
And then I have, of course, where I do trade and I have charting as well.
Trading.
Great. Any other questions? Thank you, Brian.
Thanks, Ray.
You're welcome.
Thank you, Ray.
Thank you.
Hello.
All right, guys.
Hello.
Oh, hi.
Can you share again your contact information slide again?
Oh, yeah, sure. I'm sorry, what's your name, please?
My name is Shiva.
Nice to meet you, Shiva. So
Hi.
there's my contact information right there, Shiva. So let me erase that.
Okay, thank you.
You're welcome. All right, guys. Well, enjoy your evening. Have a good night. Thank you for coming in. And I will do one of these when it gets closer to the FOMC and see if there's any opportunities, and then I can share with you what I have as well. Other than that, thanks,
Thanks, Ray.
guys.
Have a good night.
Have a good night. Take care.
Yes.